Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you how to make smarter trades. And in tonight's video, I want to go over all of the trades that we made for today, which is Thursday, March 26th, as well as the one closing trade that we had for yesterday. And since it was just one small closing trade, we just wanted to cover that in tonight's video. So today is really all about iron condors, really. We had a slew of opening trades in iron condors, an iron butterfly, and so it was a really, really interesting day to actually put some premium on, because the markets were a little bit crazy, and that's what you have to do when things are looking like implied volatility is, you know, kind of peaking or heading higher. You got to start putting on trades, and that's exactly what we needed to do. The first thing I want to go over tonight is actually the closing trade from yesterday. So again, this is not a trade for today, Thursday. This is a trade that we closed out of yesterday, which is Wednesday. And this trade is really the classic example of why you roll a contract. So we actually ended up entering SMH on a March trade. So we were trading SMH, the 57.58 call spread, but we were actually trading it during March. And so as we get towards the end of March expiration, which again, you can see right here on the chart, is right here. This is March expiration, the day before March expiration, that green line. Again, we had the 57.58 contracts, which means our break-even point was right around where I'm drawing the line here on the chart. Now, we were able to extend the trade and move this contract out to April expiration, which is this line right here on the chart. So we were able to extend this trade for a credit. And the whole reason that you do that versus just closing out the trade is so that you get all of this additional time to be right, because you don't know if the stock's going to turn around or if it's going to keep going. If you can do it for a credit, you still reduce your risk, which is why I like to roll for a credit. But we also get that timeline, that extra time, those extra 30 days to see if we're actually right in our trade. And you can see that it only took another 2 days before SMH had a huge move lower, and obviously gave us an opportunity to close out this trade yesterday. And that's exactly what you have to do. And this is honestly a textbook example of why you would roll a contract and why it's so important to take in a credit when you roll a contract, because now we were able to close out this trade at a 15-cent debit and take a nice $44 profit on it. So not a gigantic winner by any means, but it's just, again, a classic example of why you roll correctly into more timeline, more duration in the trade, and then you have an opportunity to close it out for a profit. All right, so let's get into the closing or the opening trades today. Again, like I said, all iron condor trades. There's a couple little tweaks that we did to them, namely the iron butterfly and USO. But let's start off here with DIA. Now, again, the name of the game here is just entering trades when the market's favorable. Now, earlier in the morning when the market was really favorable, and as we started to head towards kind of the middle afternoon, the market was still really favorable and implied volatility was going higher. So that's why we entered these. In most of these, implied volatility has subsequently come down, but when we entered these trades, it was all over the 50th percentile for sure. Now in DIA, we entered the 184, 186 call spread and the 162, 160 put spread. Now you'll notice that this is a $2 wide spread, so we did take in a nice credit of about $48 on that spread. So with DIA, and let me go back here, I'm clicking too fast. Oops, still clicking too fast. With DIA, obviously the market was moving lower, implied volatility was moving higher, so it did tick above the 50th percentile today. It was up around actually about the 55th percentile. It's now down, settling around the 48th percentile, so it's just moving fine right now, even after we enter this trade. And what we look to do is enter each of the short strikes for DIA at about the 15% probability of expiring in the money. So you'll notice on each end that our short strike, which is the first one here, is about the 15% probability. It's actually a little bit less now because implied volatility has come down, but that's where we were targeting, and that's about the 1 standard deviation mark on either end. Now you'll notice that just distance-wise, distance from the at-the-money strikes, the put side is obviously a greater distance or a greater number of contracts. So it naturally is going to adjust based on probabilities where these strikes need to be to compensate for possibly a bigger move down in the security in the put region, a bigger move down in the security if the stock falls or if DIA falls. So it's really good though I always like to, in most cases, try to enter these at about an even probability on each side. So in this case, you can see our probabilities are very even and balanced with the DIA trade. All right, so with USO, it was a little bit different. We already had a position in USO. We had an iron butterfly below the market. So we're already going to add another iron butterfly above the market just a little bit. We were kind of a little bit bullish here on USO, but again, we already had a position below the market, so we feel comfortable adding another position above. We did the 1822 calls and the 1814 puts. So what makes this an iron butterfly is that the short strikes are both exactly the same. So you'll notice that these 18 strikes are exactly the same. And so that means we're basically doing a strangle right over the 18 strike. And then we go out 4 strikes and we buy protection on either end. So we go down to the 14 strikes on the put side and we go up to the 22 strikes on the call side. And that gives us some protection and it reduces the margin that's required to hold this trade. Now we took in a nice $215 credit, so our break-even point gets moved out about $215 on either end from where USO is trading. Now, the reason I like USO and I continue to get into it is because it's got crazy high implied volatility right now. It's up in the 71st percentile. It was much, much higher today. And although the stock is rallying just a little bit, I think it's going to take some time for this oil market to kind of find a base. And so that's why I'm comfortable, again, making these trades. And that's all we have to do. We don't exactly know where the market's going to go, but we can make high probability trades and we can start to sell premium as soon as we get an opportunity. So with USO, this is what our position looks like currently. And let me just take off the May contracts so you guys can see what April looks like. So again, we have this iron butterfly in April. The iron butterfly in April is centered around around the 16 strike. So that's where we want it to trade. Oil is trading right here about 18 right now. So that's why we are going to recenter our new trade around this 18 strike. So now when we look at the new trade, you can see that, I'm just kind of throwing it up here, that the new trade is again centered around this new movement in the stock. So we're always trying to move with the market. We're not trying to take too big of a position at one particular price. We're trying to kind of spread out our strikes, spread out our positions, and definitely with oil, because implied volatility is really, really high, this gives us a great opportunity to be more of a net seller of premium and taking a little bit more credit. All right, so SPY, very similar to what we did in DIA. We went ahead and did the 214, 216 call spread. Again, a $2 wide call spread and a $2 wide put spread, the 188, 186 credit put spread. Took in a $51 credit on SPY as well. And with SPY, you'll see where we put our strike prices was very similar to what we did with DIA in trying to make this thing about as even on both sides as humanly possible. And so here's our 2 strikes here. See if I can fit them in the same window. So you can see on the call side, the probability of being in the money is about 14.75 or 14.71. On the put side, it's about 13.17. Again, because implied volatility has already dropped. But you can see how consistent and mechanical we have to be in entering these trades. There's really not much thought that goes into it. Once we meet some criteria as far as implied volatility, it's just a matter of finding the strikes that we want to trade and entering those strikes on a consistent basis. And that's exactly what trading should be. It's not a lot of thought and emotion. It's really more of a systematic and kind of robotic approach to how we do things. So you can see that SPY and DIA are very similar. And they should be, and that's just that we're just kind of spreading the risk among SPY and DIA just to help diversify ourselves a little bit more. Now, in addition, we also added a position in TLT. Now, we had a position for last month in TLT that went well, have a current position in TLT that's going very well, and so now we're adding another position in May, continuing to stack or ladder our trades out into the future. With TLT, we did the 137, 138 calls and the 122, 121 puts. And because they're only $1 wide, we did have to increase the number of contracts that we traded. And so we took in about a $24 credit on each of those spreads that we sold. So same thing happens with TLT, really high implied volatility right now. The stock is kind of all over the place because bonds are moving and changing and shifting. And so with implied volatility up in the 60th percentile, it just gives us a really good opportunity to enter this trade and again, outlay some more premium for the next month. With TLT, we did play it just a little bit closer to the vest as far as probabilities, but very, very similar to what we're doing with SPY and DIA. You can see both of our short strikes were right around the 15% probability of expiring. And again, just being very systematic, very mechanical here. I mean, it's honestly, sometimes it's kind of boring doing this, but this is what you need to do to be consistent in this business, is get into this repetitive nature of waiting for a good opportunity and then outlaying a lot of premium to get into that. So again, with TLT, we've got a really good position on really nice iron condor that goes all the way up to 137 and 123. And you can see if we go back to the chart here, that 123 is about down here and 137 is all the way up here. So we've got a really wide profit window here that we can make some money with TLT. Now, before we end here, just again, a word on kind of portfolio strategy and what we're looking to do here. You'll notice that all of these positions, as I mentioned in the alerts, all of these positions are fairly small. So we only did one contract. We did 3 contracts, but there are short strikes or narrow strikes. And this leaves us an opportunity to continue to add to these types of trades. So that's what we want to do. In all cases that we saw today, except for really USO, which had really high implied volatility, DIA, SPY, and TLT has fairly high implied volatility, but it could go higher. So we want to leave ourselves room cash-wise to add to these positions and increase our exposure if implied volatility goes higher. And I think that's a really key point, is we don't want to just outlay and kind of throw up all of our money on the market, right? We don't want to put everything into the market as soon as implied volatility spikes just a little bit, because it can definitely expand more. And if it does, we want to have some cash available to take advantage of that. So as always, I hope you guys enjoy these videos. If you have any comments or questions, please add them right below. If you're watching this video somewhere else out there online or on YouTube, you just have to understand you're getting this video about 15 to 20 days after it's sent out to our members. So if you want real-time alerts like the ones you see in this video, you've got to sign up for a membership at Option Alpha.